You swipe the card. The machine beeps for exactly 2 seconds. You feel like you won something. Then the feeling fades, and somewhere underneath it, a number gets a little heavier. You already know this. Everyone knows this. And yet almost none of us ask the one question that actually matters. Who benefits when you feel that way? Because debt isn't just something that happens to people who are bad with money. It's a machine built over centuries, refined by mathematicians, psychologists, and bankers, designed to make borrowing feel like winning and repaying feel like nothing at all. This isn't a story about willpower. It's a story about design. And once you see the design, you can't unsee it. Stay with this one, because by the end, you'll understand why a system built 200 years ago is still deciding what's in your wallet today. Here's something almost everyone has lived through. You get a raise, real money, on paper, more than before, and somehow, 6 months later, you have less breathing room than you did before the raise ever happened. Nothing dramatic occurred. No emergency, no disaster. Just a slightly nicer apartment, a car upgrade, a few subscriptions that felt harmless one at a time. Each decision made sense alone. Together, they quietly ate the raise before it ever reached your savings. Economists have a name for this, but the name isn't the interesting part. The interesting part is that this pattern isn't random. It's predictable enough that entire industries build their pricing around it. Car dealerships, credit card companies, and phone carriers don't guess that you'll spend more when you earn more. They plan for it. Your income rises, your lifestyle rises to meet it, and the gap between what you earn and what you owe stays exactly the same size it always was, just with more zeros attached. That gap is where debt lives, and the people who profit from that gap have spent 100 years studying exactly how to keep it open. To understand why debt has this grip on us, you have to go back further than credit cards, further than banks, even. You have to go back to a sewing machine. In the 1850s, a sewing machine cost more than most families earned in months. Almost nobody could buy one outright, so the company that made them did something that had never been tried at that scale. They let people pay a little bit now, and a little bit later, until the machine was theirs. It worked not just as a sales tactic, but as a psychological discovery. People who would never save up $100 would happily agree to pay $5 a month forever without ever doing the math on what forever actually cost them. That one idea, split the pain into pieces small enough to ignore, became the blueprint for the entire modern economy. Car loans, mortgages, credit cards, buy now, pay later checkout buttons. Different centuries, same trick. The people who built this system weren't villains twirling mustaches. They were following a pattern they'd stumbled onto by accident. Humans will agree to almost anything as long as the cost is broken into pieces too small to feel. And that pattern didn't stay in factories. It moved straight into your brain. Here's where it gets strange. Neuroscientists have scanned people's brains while they thought about their future selves, and something unexpected showed up. When you imagine yourself 10 years from now, the part of your brain that lights up isn't the part that activates when you think about *U**. It's closer to the part that activates when you think about a stranger. Your brain, in a very literal sense, does not fully believe that future you and present you are the same person. That single glitch explains an enormous amount of financial self-sabotage. When you swipe a card today and agree to pay it off later, you're not really making a deal with yourself. You're making a deal on behalf of someone who feels like a stranger. And it's much easier to spend a stranger's money than your own. This is why debt rarely feels dangerous in the moment it's created. The danger is scheduled for a person your brain hasn't fully agreed exists yet. Understanding this isn't just interesting trivia, it's the first real tool against the trap. The closer you can make your future self feel, picturing them specifically, naming what they'll actually be dealing with, the harder it becomes to hand them your problems. But the sewing machine trick and the stranger in the mirror are only 2 gears in this machine. The next one was built on purpose with a calculator. Open any credit card statement and you'll find a small, unthreatening number, the minimum payment. It looks responsible. It looks like the safe option. It is, mathematically, one of the most expensive decisions you can make. Pay only the minimum on a typical credit card balance, and it can take over 15 years to clear a debt that felt small enough to swipe without thinking. Not because you borrowed too much, but because that minimum number was calculated to keep the balance alive as long as legally possible while still looking harmless on paper. This isn't a conspiracy theory, it's published math. Minimum payments are typically set as a small percentage of the balance, low enough that the interest keeps regenerating almost as fast as you pay it down. You're not climbing out of the hole, you're mostly just refilling it more slowly than you're digging. Here's the practical takeaway, and it's simple. The minimum payment isn't a suggestion of what you should pay. It's the number that makes the lender the most money over time. Anytime you can, pay more than it. Even a small amount more. Because that's the exact lever the system is betting you won't pull. The machine doesn't need you to be reckless. It just needs you to follow the default. If you think this trick belongs to a different generation, look at your own checkout screen. Somewhere on it, there's a good chance you've seen the phrase for interest-free payments or pay in installments. It looks like nothing. It looks like a courtesy the store is doing you. It is, almost exactly, the sewing machine trick wearing a hoodie. Split the pain into pieces small enough to ignore, remove the word interest so it feels free, and let the checkout button do the rest. That last detail is the part worth sitting with. The tool isn't marketed as a way to help you afford something. It's built and priced to the merchant, specifically because it makes people buy things they'd hesitate to buy in full. None of this makes the person tapping confirm foolish. It makes them exactly as human as everyone in this story so far, reacting to a small number instead of the real one, right on schedule, exactly like the machine was built for them to do. There's a quieter force at work too. One that has nothing to do with banks and everything to do with the people around you. Humans are wired to measure their own success by glancing sideways, not by looking inward. It's an old survival instinct. In a small tribe, knowing your status relative to everyone else actually mattered. In a modern world of feeds and filtered photos, that same instinct just means you're constantly comparing your real life to everyone else's highlight reel. Not because they need the item, because their internal ranking system just quietly shifted. Nobody sits down and decides, I will go into debt to keep pace with people I don't even like. It happens in tiny, invisible increments. One purchase that feels like catching up, not falling behind. This is why debt so rarely feels like a decision. It feels like just staying normal. And the uncomfortable truth is that an entire economy has learned to run on that feeling. This next part is the one most people never get told, and it changes how the whole story looks. Consumer spending makes up the majority of economic activity in most developed countries, and a large share of that spending isn't paid for with cash sitting in a bank account. It's paid for with borrowed money that hasn't been earned yet. That means modern economies aren't just tolerant of household debt, they're structurally dependent on it. You are not failing at a neutral game. You are playing inside an economy that quietly needs you to keep swiping to keep functioning. That doesn't mean debt is some grand plot against you personally. It means the incentives at every level, corporate, psychological, and national, all point in the same direction, toward more borrowing, not less. Once you see that all four of these forces are pointing the same way, the sewing machine, the stranger in the mirror, the minimum payment, the neighbor's new car, and the entire economy's growth chart, debt stops looking like a personal failure. It starts looking like exactly what it is. A very well-designed system, working exactly as intended. The only real question left is what you do once you can see it. There's one more piece of this machine, and it's the part that makes leaving it hardest of all. Somewhere along the way, a 3-digit number started deciding things that have nothing to do with money in your hand. Whether you get approved for an apartment, what interest rate you're offered on a car, sometimes even whether an employer looks twice at your application. That number is your credit score, and here's the part almost nobody explains clearly. It doesn't just measure whether you can be trusted with debt, it rewards you for having some. The system isn't built to reward debt-free living, it's built to reward *managed debt. Just enough borrowing, kept just current enough forever. That's the leash. Step too far from debt, and doors quietly start closing. Stay wrapped around it at a healthy level, and the doors stay open. as long as you keep paying. This isn't a reason to panic about your score. It's a reason to stop assuming the number is a neutral judge of your character. It's a scoreboard for a game that was designed from the beginning to keep you playing. None of this means debt is always the enemy. Used with intention, a mortgage on a home you can actually afford, a loan that builds something instead of just filling a gap. Debt can be a tool. The danger was never debt itself. It's debt you can't see, agreed to on autopilot. Buy a version of yourself your brain barely believes is real. So here's where the story leaves you. Before your next purchase on credit, try picturing the specific person who will pay it off. Not future me in the abstract, but the actual Tuesday morning bank balance of the person 3 months from now. Check whether you're paying the minimum out of habit, and change it if you can. Notice when a purchase is really about catching up with someone else's life instead of building your own. The system was never going to warn you about any of this. It profits from you not looking. But now you have looked, and a machine you can see is a machine you can finally choose whether to use instead of the other way around.